So are you new to Forex?
Yes.
So you have no idea.
He has shown me a little bit of the market makers method. So I have a minimal understanding. I understand what candles are. He showed me railroad tracks and the M's and the W's and
Okay. So the part of price action. Do you know it? Do you have an idea of
that's about it.
the part of price action?
He's talked a little bit about price action.
The support, resistance, the trend lines.
Yes.
So you have an idea of the support areas, the resistance areas. Okay.
A little bit.
Well, I need you to have just an idea of the support and resistance and the trend lines in order for you to learn the MMM. Okay?
Okay.
I should read the disclaimer first.
Yes, I agree. Okay, I've read that.
Okay, thank you. Now, usually I start with the financial markets. You need to understand what you're getting into. So Forex market is a financial market. So basically financial markets bring together people and organizations wanting to borrow money together with those having surplus funds. So in the financial market, there are investors and there are fund managers. So the investors, they give the fund managers their money and they expect a return. So you made this investment decision to trade the Forex market because it's an investment decision and you need to get the required rate of return, but you need the return with minimum risk. So the market players in the financial markets know this and have developed various instruments, practices, and strategies. And in the instruments, you can see the currency pairs. These are the assets, the security assets, the bonds, the stocks, the derivative products. I don't know if you're getting me there. Amy.
Yes.
Okay. So various instruments, practices, and strategies have been devised and developed in the recent past. And they opened boundaries for international trade and business, just why the Forex market is worldwide now. So the world trade has gained momentum in the last decade, and the world has entered in the new phase of global integration and liberalization. So as market players increases, then the movement of markets becomes more risky. So the integration of capital markets worldwide has given rise to increased financial risk, where there are frequent changes in the interest rate, the currency exchange rates, and stock prices. So because the market players are many now, so the risk is high than as it was back then. Although the market is the liquidity of the market is high, as you can place an order and it's executed at the moment. So to match you with to match the buy and sell orders the matching has become easier because the liquidity is high. The market players are mean. So we need to look on the types of markets. And we'll talk on the types of general markets. As you know, generally a market is a place where you go and buy and sell goods, a place where people buy and sell goods. So we have the physical assets. This is the financial asset markets. The physical asset markets, also called the tangible or real asset markets. See, this deals with those tangible products, the products like with the autos, the real estate, machineries, the computers, anything you touch. So you find them in the stores and products. That's a physical asset market. So the financial asset markets, on the contrary, deals with the abstract assets, the stocks, the bonds, the notes, the mortgages, the treasury bills, all that, and other claims of real assets, as well as derivative securities. Derivative securities are derived from changes in the price of other assets. For example, a share of Ford. A share of Ford is a pure financial asset, or you can have a derivative product whose price would move as the price of the Ford stock. Like the value depends on the price of the Ford stock, the value of the derivative product. So these derivative securities are products in which the value of the product depends on the price of the underlying asset. So the underlying asset can be a stock, yes, a currency pair. So you can have an option to buy maybe a Ford share. Amy?
Oh, yes, there I can hear you.
Yeah, there's a little internet connection problem. Okay. So
yes.
I was talking on the derivative products. So a derivative is a financial asset product. It's a financial asset whose value depends on the value of the underlying assets, as the value of the derivative is derived from the value of the price of the underlying assets. For example, a Ford share can have its own derivative. A Ford share is a financial asset product, but it can have a derivative, and the derivative can be an option or a forward. You can jot them down and you can read about them later. Option or forwards. So an option, you can have an option to buy a Ford share. So that's a derivative security. So those are derivative products. And then the financial asset market, the Forex market falls on the financial asset markets. Okay.
Yes.
We have the spot, which is the future markets. Now the spot markets are markets in which assets are bought also on the spot delivery, I mean. Literally within a few days, but usually the execution is on the spot. For example, the Forex market, when you buy or sell, the execution is usually on the spot. Okay.
Okay.
We have the future markets. Now, the future markets are markets in which participants agree today to buy or sell an asset at some future date, but the price of the asset, the price to execute a certain trade is set today. So they set the asset today, but on some future dates, the execution is to be is to occur. I mean. Now, example of the futures, we have the option products and the forward. We have the future markets in the financial markets. The options and the forwards are the future market. A simple example of a future market is when suppose you want to buy a land. Now it's 2019. So around 2021, you anticipate that the land will be worth, maybe right now it's worth $8,000. Maybe in 2021, you anticipate it would worth $10,000. So the owner, you and the owner of the land will enter an agreement that you would buy the land in 2021 at a price of $10,000.
Okay.
So when 2021 reaches, you need to execute that order. The agreement needs to take place. I mean, so you need to buy the lands, and you buy it at $10,000. Now, in order for the owner of the land to secure that land for you, you need to pay a certain price. So that's call it like a contract fee.
Yes.
So here on the future markets, we have two types of products: the options and the forwards. Now, the options, when you have an option, when your order is when your agreement is in option contracts, then you have the right to buy the land, but not the obligation. But when it's the forward, you will have the obligation to buy the land. Now, suppose in 2021, the land is worth $21,000. Okay. So
Okay.
with the option contracts, you have the right to buy it at $10,000. Okay.
Okay.
But with the forward, you have the obligation to buy it at $10,000, even if the land is $11,000. But if the land is worth maybe $9,000, with the option contracts, you have the right to buy at $10,000. So you can terminate it and not buy the land. It's okay. But with the forward, you need to buy it at $10,000. It's an obligation. So those are the difference between the options and the forward in the future markets. So you should have knowledge in the financial assets markets when you come across the options, and you understand them. So we have the money markets, there's the capital markets. Where in the money markets, we talk of the short-term, high liquid debt securities. When we talk of the bank loans, the treasury bills, those kind of debts which take less than a year, those are executed on the money markets. Well, the capital markets are the markets for intermediate or long-term debt and corporate stocks. So here we have the bonds, which take more than 10 years. Those are long-term. We have long-term debts, which take 1 to 10 years. We have the notes. So those fall in the capital markets. Okay.
Okay.
We have the primary versus the secondary markets. When a corporation raises new capital via shares, they would issue new shares when they issue new shares for the first time. So the transaction is done on the primary market. So there, the investor, The investor who wants to buy the new shares will go through underwriting in the primary market. Now, once the new stocks have been issued and the stocks now are already existing, they are already outstanding, the securities can be traded among investors in the secondary markets. Those are the difference between the primary and the secondary market. So the New York Stock Exchange, the London Stock Exchange, here in Tanzania we have the Dar es Salaam Stock Exchange, they are all secondary markets, where an investor can trade the shares, the securities among one another. Also, the Forex market is the secondary market. So we have another category of the private. This is the public markets. The private markets, two people come together, they negotiate, and transactions are done. While the public markets, they're standardized contracts, and they're traded on organized exchanges. The Forex market falls on the public markets. When you sign up to a broker, for example, the broker is ForexSPV. So when you sign up for the first time, you have the terms and agreements. And when I sign up to the same broker, I will have the same terms and agreements. When you execute an order on EURUSD and you see the spread there is maybe 2 pips, I also see 2 pips on my screen.
Okay.
So that's the standardization that the public markets have. So another characteristics of the public market is that the investors have access to information on the asset they are trading on the organized exchanges. Just where you have the Forex Factory, the investing.com, where you find the news release and some analysts talking of the news, and you have the Bloomberg, the CNBC. So we have them because the public market, it's an obligation of the public markets to give out information to the investors. Okay.
Okay.
Now, for a healthy economy is dependent on efficient fund transfer from people who are net savers to firms and individuals who need capital. So, for example, you make it in Forex, if you want to own a hedge fund, so you should understand that when you take money from people, you need to be very careful in managing the risk, and you have the returns in order for the economy to be healthy. So without this efficient transfer, the economy simply could not function. Okay?
Okay.
So let's go to the dealers market. While the stocks of most large companies trade on the New York Stock Exchange, a large number of stocks trade off the exchange in what has traditionally been referred to as over-the-counter markets. Okay.
Yes.
Now, on the past, the exchanges they operated as auction markets where buy and sell orders come in more or less simultaneously, and exchange members, they match this order, they match the buy and sell orders as auctions. Now, if a stock is traded infrequently, perhaps the firm is new, the firm is small, then the buy and sell orders come in few. Matching them within a reasonable amount of time would be difficult. It was difficult. Now, to avoid this problem, some brokerage firms, they maintain an inventory of such stocks. So they had the buy and sell orders, and they stand prepared to make the market for these stocks. Now these dealers they buy when individual investors want to sell, and sell part of their inventories when the investors want to buy. So they hold the buy and sell orders, and when you as an investor come and you want to buy, they sell part of their inventories, and when you want to sell to them, they buy from you. Okay?
Okay.
So at one time, the inventory of securities was kept in a safe, and the stocks, when bought and sold, were literally passed over the counter. That's why we call them the OTC market, the over-the-counter market. Now, the Forex market falls on the OTC markets. Now, today, these markets are often referred as the dealer's market. Okay?
Okay.
Because the dealer stands there and makes the market. So a dealer market includes all facilities that are needed to conduct security transactions, but they are not made in physical location exchanges. Okay?
Okay.
The facilities include relatively few dealers who hold inventories of these securities. So in the Forex market, they hold inventory of the currency pairs. And these dealers are said to make the market in this security. So they are market makers. And there are thousands of brokers who act as agents in bringing the dealers together and the investors. So the brokers are simply agents, and they're paid with commission. They pay the commission. Okay. So if you find a broker is giving you brilliant ideas like they see USD is selling, I mean pound USD is buying, and all. There's a certain broker in my mail. I'm in their mail listing. So I was reading their FX primers. So I was reading their market sentiment gauge for this week. They say that people going long on Euro USD are around 94%, going short is 6%. Pound USD, when I say going long and short, you understand.
Okay.
Do you understand the term long, going short?
Yes, a little bit.
Okay, going long is people buying and going short is people selling.
Yes.
Okay, so I'm reading the market sentiment gauge. They sent me this. They sent me today this. As people going long for USD around 94%, going short is 6%. On pound USD 61, 39%. Going long is 61, going short is 39%. Now let's look on the markets. This is the market today. This is Euro USD here. You see it went short today. And here
yes,
on their buyers, their gauge says that this market will go long. So if you see a broker giving you brilliant ideas on the market sentiment, don't take it. They usually don't know if the market will go up, will go down, or will go sideways. They only want you to put your money on the trade, and they will get commission out of it.
yes.
So I usually don't take their words. Okay.
Okay.
Now let's go on. So one of the characteristics of the dealers market is that there are computers, there are terminals, and the electronic networks. This provides a communication link between the dealers, the brokers, and the investors. Okay?
Okay.
Now, the dealer who makes the market, the dealers who make a market in a particular stock, they quote the price at which they will pay for the stock. We call it the bid price, and the price at which they will sell the stock to you. Okay? We call it the ask price. Now, each dealer's price, which are adjusted as the supply and demand condition of the market change. So the ask and bid price are adjusted as the conditions of the market change. So when you talk of the changes in the conditions of the market, we mean that when the market players are few in the market, you'll find the ask and bid price. Well, the difference between the ask and bid price is called the spread. So I find the ask and bid price. Let's take a look on the market right now.
One moment, please. Sophia, your plate's on the table, but you have to eat it down here, please, okay? No food upstairs. Okay, thank you.
Okay. Now let's look on the market here. See here, there's a black and a yellow.
Yes.
Line here. Now this is the ask and bid price. So the difference here is the spread.
Yes.
I hope you are aware of that. Now this spread, the bid ask difference, the spread will become bigger. I mean, the dealer will open the spread when there are few market players in the market. That's when the liquidity in the market is low, because the main responsibility of the dealer is to make the market. And how do they make the market? They trap a certain liquidity at a certain level. Like if the market is to go up, they will trap liquidity here. So they will trap traders low, and then they will swing the market away. So
yes,
the liquidity that is to be trapped here should be enough for them to swing the market away. Now, if the market players here are few in numbers, they will open the spread in order to find enough liquidity. So suppose other market players have put pending orders. Do you know about pending orders? Amy?
yes,
You know about pending orders? Amy?
yes.
Do you know about pending orders? Do you have knowledge?
Say that again.
Do you have knowledge on the pending orders? The buy stop, the sell stop?
A little bit, yes.
Okay, so suppose the dealer is trading low, okay?
Okay.
And there are pending orders around this area. So these pending orders may be worth around 200 million USD, okay? And the dealer needs this 200 million in order for him to swing the market away. So he would open the spread. So he offer a spike here, and around this orders, he would open the spread, the ask and bid. He would open the spread and he will fetch the orders. So the orders will be executed. If they are the sell stop, like people want to sell from there, so you execute the orders, trap them, and then they would buy, swing the market away from them. So this liquidity here would be trapped. And suppose people have put their buy orders around this area while the dealer is consolidating and the stop loss are here. So maybe 20 pips stop loss. So the dealer may go and fetch the stop losses, go and hit the stop losses, and then he'll swing the market away. Because in hitting the stop losses, in opening the pending orders against their real attention, that's where he finds the liquidity he needs. So as the supply and demand conditions of the market change, the dealer would open the spread. You'll find it during news release, the spread is opening up. So there is where the market players are few. And dealer needs enough liquidity for him to swing the market. So,
Okay.
and the spread now, the bid and ask spread is the dealer's markup, it's the dealer's profit. So the dealer's risk now, the dealer's risk increases if the stock is more volatile or if the stock trades infrequently. So if the stock is more volatile, so the inventories that he has, some people will not go trade a certain stock because of the volatility that it has. So generally, we would expect volatile, infrequent traded stock to have wider spreads in order to compensate the dealers for assuming the risk of holding them in the inventory. That's why you find the exotic pairs having a larger spread. The commodity pairs, they have large spread because the dealer compensates for assuming the risk of holding those pairs in these inventories.
Okay.
Okay. Now you need to understand that the market is not free. It's manipulated like a puppet. The three major manipulators are the liquid providers. Who are the liquid providers? The dealers. We have the top currency traders, the banks. In the banks, they are the dealers, and they're working on the dealing desk, trading desk. The trading desk.
Okay.
And in the hedge funds, you see hedge funds have a very, very large capital and they're not regulated at all. So they would enter in the market with a very large capital. So their orders have significant effects on the market. So suppose they sell the dollar and they enter with a volume of maybe 5 billion USD. And suppose 3 hedge funds have entered, so the dollar will drop eventually. We have the brokers. Some brokers, the non-ECN brokers. ECN means electronic communication network brokers. The ECN brokers do not manipulate the market, but the non-ECN brokers, they usually manipulate the market because they are the dealers themselves.
Okay.
And these non-ECN brokers, they are the offshore, they're called the offshore brokers. They're not regulated and have a very large spread because their spread is, the spread is their profit. The ECN brokers, you find them with small spread because they're paid with commission. And you find the ECN brokers, they are finding people to sign up on their brokerage firms and sign up under them. And the ECN brokers usually have dealers. They have dealers who, for example, one ECN broker can have dealers from Barclays, from Citibank, from the New York Stock Exchange. So each dealer would give him the ask and bid price. So he'll feed the ask and bid price in the computers and he'll select the best ask and bid price. In selecting the best ask and bid price, there you'll find the very small spread because the best will result to a small spread. So I won't go into details on how they manipulate the market. So this one is just for one who would be reading this book. Simply understand that market makers are business. Now we know the market makers are the dealers. Then business, and in every business needs to make money. Unfortunately enough, Retail traders are the customers to this business. So we are the customers. Market makers are constantly hunting your stop loss using algorithms that scan your entry point, your stop loss, and take profit. This algorithm then fluctuates according to the mass amount of orders it is receiving and where the retail traders have placed their stop losses. The intention here is to hit as many stop losses as possible, while at the same time avoiding to hit the take profit levels of retail traders. So you should understand the market as that. Your mindset should understand that this is business, so you need to treat it as a business. And this business is as true as any other business. We call it a zero-sum game. What you're losing is what the other is gaining. So in the end, it's the zero. It's a zero there. The negative plus positive is a zero. And in knowing the market maker method, you will be on the winning side, be on the winning team.
Okay.
Now, in order to trade like the market maker, in order to trade like a dealer, you need to understand the capabilities of a dealer, the limitation that he has, the patterns, the cycle, all that. In order to trade in line with him, you need to understand that.
Okay.
Now, market makers can do the following. They have the following capabilities. They can use traders to take position. So people have read in the books that in the areas of support, in the areas of resistance, there are certain candlestick patterns. So when these candlestick patterns happen, so you sell, you buy. So the dealer knows that. So the market maker knows that he would go at a certain support area, at a certain resistance area, gives the pattern, induce traders to take position. After taking their positions, they would scan their stop losses, hunt their stops. After hunting their stops, then he would move in the direction he needs to move. So the support and resistance area exist, and usually price reverses in the support and resistance area, but the dealer doesn't reverse the price not unless he has enough liquidity for him to reverse that price. So you see he's hunting the stops. After dealing with the stop losses, then he'll swing the market away. So that's the capability that he has. He can create panic and fear to induce traders to become emotional and think irrationally. So this is a game of emotion. So
Yes.
the psychological part is very important. So you may find yourself getting emotional and you make irrational decisions. That is where the dealer would smash you. So you find the quick moves, the spike candles during news release, there are certain price behavior that is inexplicable. So the dealer would make all those in order to play with your emotions. So you need to take care of the emotions there. The dealer can hit the stops and clear the board. We've talked about it. They know who is in margin trouble. I don't know if you know about margin trouble, the margin calls, but unless you have traded a bit and you reach that situation of blowing an account, then you find a margin call. The broker will send you a margin call on your email, on your SMS. So send you that, tell you that margin level if your account has fallen below the minimum maintenance requirement of 80%. Kindly take urgent action to avoid stop out.
Okay.
When you see this margin call alert, you should know that even the dealers know that you are in margin trouble, and suppose many accounts are in margin trouble, they will make sure that they wipe the accounts, have enough liquidity to swing the market away. So another capability is that they can toy with the spread.
Okay.
Say they can open the spread, close the spread, depending on the market conditions. So knowing the capabilities, we need to know the restrictions. So there is one of the restrictions is that they are restricted to move the ability to move price to a general range. They are limited to move price of a currency pair to a general range, a certain number of pips per day. So we call it the average daily range. Okay?
Yes.
So the average daily range, the short form is the ADR. For example, the ADR for card JPY is only 49 pips. So our template here has the ADR. This is
Okay.
49 pips. So you see today the dealer completed the ADR. So once he completed
Yes.
the ADR, you find the red. See this ADR markers would glow red. This is pound
Yes.
USD also is completed the ADR today. Same to pound card. USD ZAR has not completed the ADR. See the ADR markers. They are this color, like this yellow. So this is Euro USD just completed the ADR today. So when the dealer has completed the ADR, you find him reversing on that area. See, it's completed the ADR. So they are limited to the average daily range, the number of pips to move the pair in a day. So another limitation is that their equity is limited. They have no, they do not have unlimited equity. So they cannot enter in the market and put bigger lot sizes that they will destroy the world economy, or they will they will collapse the market. So their equity is limited. That is one of the restrictions that they have. Are we together?